Well, hi and welcome. My name is Casey Boland. I'm a wealth advisor with HCM Wealth Advisors. I'm joined today by Doug Johnson, who's our senior investment strategist, and Dan Rinck, who's a research analyst with HCM Wealth Advisors. Welcome to our webinar. So if you'd like to ask a question, please go to the bottom of your screen and click on Q&A, and there you'll have an opportunity to submit your question. And we will do our best at the end of our webinar to answer your questions. All right, guys. Doug, I heard your little SOS. Hopefully that wasn't a message to the Federal Reserve here.
Yeah, when I was listening to that go over and over, I was thinking to myself, I hope we're not sending the wrong message here. But no, I don't think that was quite the intention of that song.
All right, so let's date and timestamp this. So this is September 21st. We're right at 4 o'clock, and you can see in this picture, we've got the picture of a pause button. And the Federal Reserve concluded their meeting yesterday with a pause on interest rates. And, if you look closely at this pause button, it also looks like the number 11. And ironically enough, the Federal Reserve has increased interest rates 11 times during the cycle. And, 11 is usually considered a lucky number, 7, 11. 11's treated Cincinnati pretty well. As the great Cincinnati Red, Barry Larkin, donned the number 11. And when I was 11 years old, that was 1980. And any guess on what the stock market average return has been since 1980 until 2023? You guessed it, right around 11% per year. So what a time for baby boomers. They had to walk uphill to and from school in the snow. And you know what? You were dealt with a pretty good hand in the stock market. So I need to say, note to self, Dad, why didn't you put my allowance into the stock market instead of passbook savings here during that time frame? So, all right, let's continue on. Let's talk about the Fed meetings highlights. Rates. So they were unchanged. They're right around that 5.25% to 5.5% area, which is a 22-year high. The tone of the Fed, it's changed. They've been more hawkish now with this forecast, indicating that rates are going to be higher for, as Doug kind of pointed out, longer, as we were putting the slides together.
That's not a typo.
Well, and it's certainly a change of posture, and there's some reasoning for that. I mean, there's some economic data that has continued to be in a positive territory, and they're still concerned about inflation. So it's the reason why that longer may hang around. And surprisingly, they bumped up those growth forecasts, and they've now have a lower unemployment peak at 4.1%. And you've got some officials, not a lot, majority are seeing, I think, rate hikes still, probably one more in 2023. I think 2024 is going to be an interesting year. You've got a presidential election year. And I think the Feds, they're not looking to make swift moves in an election year. So it's going to be interesting to see how that plays out in that year. And the good news with the picture, though, the Fed seems to be presenting now, it doesn't align with, if you remember the message back in the summer of 2022, which is Mr. T would say, my prediction, pain. Okay, I know that was a lame Mr. T impression, but specifically economic pain. And Powell said at that time, while higher rates, interest rates with slower growth may lead to softer labor markets when they're trying to bring down inflation. And they were indicating that you're likely to have pain to households and businesses. And I think the Fed has been surprised at how resilient the economy has been, highlighting the economic activity, and it's been at a solid pace. They indicated that they're in their official statement, and maybe a bit too solid, which may be contributing to their concerns about inflation. But the takeaway right now, though, is the Fed sees rates remaining elevated through 2024, but with no significant implications to the economy. All right, so let's shift and talk about inflation. And we talk about inflation specifically, there's a lot of focus on CPI, which is the Consumer Price Index. And part of the reason why the Fed's outlook may have changed a bit, more hawkish stance with these rates higher for longer, is you had inflation data ticked up the last 2 months now in a row. And you can see on this chart below, it's tracking the Consumer Price Index data. So it was a big increase in August. And the CPI, keep in mind, again, it measures the costs across a broad array of goods and services, and it rose a seasonally adjusted 0.6% for the month of August. And from a year ago, now it's up 3.7%. And when you exclude food, food tends to be more volatile. Energy tends to be more volatile. When you exclude those, you get to what the core is. And the Federal Reserve seems to focus more on core as it provides a better indication of where inflation is heading over the longer term. It increased by 0.3% for the month, and it's 4.3% from a year ago. So still above the level and the expectations of where they want inflation to be. And as we look at this slide now of more indications, the next one of the components, you can see from the component standpoint that energy was the big driver. It was up 5.6% on the month. And that's an increase that included a surge of about a little over 10% of a surge in gasoline prices. And for several months this year, though, you can see with this data, energy actually had been helping bring down the CPI number, as it had been a negative contributor to CPI. So as we look to other indicators, one of the indicators that you look at for what people consider a solid recession indicator is something called the leading economic indicators, or LEI. And it has continued to flash a recession signal. It declined in this last month in August, and it's called the Conference Board Leading Economic Index. And if you take a step back to understand what the makeup of it is, it's comprised of 10 indicators that cover a wide range of economic activity, including job growth, housing construction, stock prices. And the index is designed to provide a kind of a broad-based look at the health of the economy, and it can be used to predict turning points in the business cycle. And with the decline that we had in August, the U.S. leading economic index has now fallen for almost a year and a half, indicating that the economy is heading into a challenging growth period and possible recession over the next year. And the components recently that deteriorated, you saw weak new orders, deteriorating consumer expectations of business conditions, high interest rates, and tight credit conditions. And tight credit conditions on some level were somewhat born out of, if you remember, back in the springtime, you had the regional banking crisis, and with several banks that went under during that period of time, and while others saw a lot of strain with deposits going to some of the larger financial institutions. And there's been some concern on how that may play out with tight credit conditions. And Federal Chairman Powell seemed to indicate that the other day in his statement. But interestingly enough, Goldman Sachs recently had released a statement. When you listen to earnings calls by the components of the Russell 3000, that less of them now are indicating or mentioning even the concern or the words credit access. And that had spiked up after that springtime period with those banks running into trouble, and that's gone back down. So it seems like it's at a more favorable level, but that's still, I think, on the Federal Reserve's mind at this point. So leading economic indicators still continue to be a concern at this point. As we shift to, though, the labor market, and it is part of the LEI, but when you look at the labor market, it's the headline of this slide, hot but cooling, I think really nails it, because the labor markets continue to be strong, but it is cooling on some different metrics, and it's been deteriorating a little bit in recent months. But most of those metrics also confirm that the labor market remains tight. So the unemployment rate, which is the number of workers who identify as unemployed as a percentage of the civilian labor force, it was 3.8% this past month. That ticked up a little bit from 3.4% in recent months, but it's still right around 53-year lows. And when you think about unemployment's considered a lagging indicator for the economy, meaning that by the time you see unemployment numbers climb to higher levels, at that point in time, the economy has already been deteriorating. So if we look at other metrics in employment that are better at leading or foreshadowing the direction of the economy, So if we look at the next slide, if we look at a key metric that seems to be maybe a better driver to focus on is when you look at job openings. And as of this July, when you're looking at the current labor market as it relates to job openings to the number of unemployed people, it's sitting right around 1.5. It had been as high as, about 2 times that ratio back in, from March 2022, and it remains well above pre-pandemic levels of 1.2. So from that perspective, it's still a pretty good picture. And jobless claims is another. It's not pictured here, but meaning unemployed individuals that file for unemployment insurance upon losing their job, both first-time claims and ongoing jobless claims, those fell this last week. Those still are low numbers at this point, pointing to persistent labor market tightness, even as job growth is cooling a bit. So Doug, I'm curious, what if Federal Chairman Powell doesn't have access to government data because of a government shutdown? How do you think he's going to handle that when the next upcoming decision comes up for interest rates?
I don't know. It's a good question because, if we, obviously at the beginning of this, we looked at, the Fed forecast, and everyone pays very close attention to the minutes of the meeting, the projections for rates and where those are. But if you've looked at some past predictions from the Fed, they've been wildly off. So I think a lot of people have questioned whether or not they do get economic data on a regular basis. But I think the point that you're alluding to now has to do with a government shutdown and what that could mean to the overall economy. And this is surprisingly not in the headlines yet. I'm sure it will be. I'm sure we're going to get more questions on it. We've gotten a few. So I just wanted to take some time very briefly to walk through this. So really, is this going to be the debt ceiling all over again? What I would say is both yes and no. So the specifics of what this government shutdown looks like is there's an October 1st or September 30th, depending who you talk to, deadline. And the issue is there are 12 appropriation bills that fund government operations that are up for, we'll just call them renewal. As of now, those have not been passed. There was a Republican, offer earlier in the week that, as I read through it, probably is going to be dead on arrival in the Senate, that would push it out to October 31st. But, whether or not they're going to get a short-term or long-term solution, if this does come to a head, basically what's going to happen is it would lead to many federal employees not working. But the important thing is essential services will continue without pay. So air traffic controllers, post office, police, people who are essential to day-to-day operations will continue to report. They won't get paid, but when this does get resolved, they'll receive back pay. Social Security, Medicare, and U.S. bond interest is not affected by any of this. So all of those things will continue to flow as normal. So this is one thing that may be a little bit different from the debt ceiling is we had some talk about U.S. defaults, Treasury payments being affected. This does not have anything to do with those functions. We've had 14 shutdowns since 1981, the longest lasting 35 days in December of 2018. Our view on this is that any shutdown is most likely going to be temporary. So this is kind of the same view that we had with the debt ceiling, and that any economic or market impact will also be temporary. So I know we've had some volatility over the past 2 days, and Dan's going to talk about that a little bit more at the end. But what I would say is that if volatility were to continue, I don't believe it is a direct function of the government shutting down. And I think anything that is attributed to that will be short-term in nature and won't have a large effect. And, here are the numbers to kind of back that up. So this goes back to 1976 and lists all of the shutdowns that we've had of this type with a number of days. Again, here's the longest at 35 days back in 2018. And what you'll see is, doesn't matter who the president is, blue or red. Here's the point change for the S&P 500. So the average of all of these is right around zero. So basically no effect at all. And then if you look at the extremes, you actually had a 10% rise during the longest one of these. And then the biggest sell-off was a little less than 4%. So again, I mean, if we're looking at this as an event risk type of thing, it doesn't seem to have a big impact on the market. And therefore, we're not making any extra allocation decisions based on the possibility of this happening. Now, we've spent some time talking about fixed income, and obviously that's been in the headlines over the past few days with the Fed's decision. But we mentioned in the past webinar the kind of opportunity set for traditional fixed income assets is starting to change, and starting to change for the better. This chart here shows the difference between nominal yields, which is basically what the yield is that you see quoted on various bonds, alongside inflation expectations. And when this black line is above those inflation expectations, what you're seeing is a condition called positive real rates. So almost think of a real rate as an inflation adjusted or after inflation return that you may be seeing. So the last time we had positive real rates was back in May of 2018. Now, we had negative real rates for a long time, but then fast forward and you can see that this positive real rate number has jumped up pretty substantially. And this nominal yield number is actually higher today over the past 2 days. But as inflation expectations stay somewhat in that 2 to 2.5% range on a longer term basis, you're seeing 10-year yields continue to go higher, and you're seeing positive real yields growing. And when you have inflation adjusted yields that are that positive, it really is a good opportunity to realize some good income in the fixed income market. So, how does that translate to what the bond market is telling us? So, ironically, this slide's called Great Expectations, and it's not necessarily about the Charles Dickens novel, but here is a breakdown of what the bond yields are currently pricing in. And we know that there's an inflation component here. There always is. But it's right around 2%, maybe a little bit less than 2.5%. So nothing out of the ordinary there. Then you have something called the term premium, which we don't necessarily need to get into, but that's tracking. But I think the most interesting part about this is, with all this concern we have about recession and all the concern we have about rates going even higher, you have one of the largest expectations of real growth coming out of bond yields right now. So the bond market is obviously concerned about inflation, but it's also saying that the economy is going to continue to grow at a very good clip. And I think the Fed also reiterated that in their comments. And I think that's important because obviously the real concern here, one, is recession, and two, when a recession comes, usually it's very detrimental to equity prices. And it's really hard to have a recession when growth forecasts are this strong. So some interesting things here coming out of the bond market, basically telling us, hey, we agree with the Fed. We think the economy is going to continue to grow and be fine. Now, we've also had a lot of clients questions and requesting large allocations of cash. And right now we own probably more cash than we have in certainly since I started, and probably the past 10 to 15 years. And that makes a lot of sense. You've got cash paying you north of 5% right now, with little to no, what I'd say, price volatility to worry about what we're seeing in the fixed income market. But what this chart does, it goes back to 1927, and it shows time frames where the orange kind of bars or jagged edges or whatever you want to call those, are outperforming assets. So mainly stocks, bonds, real estate. And then the blue bars are the times when that situation is reversed. So at first glance, you look at this and you can say, okay, going back almost 100 years, the amount of times where the asset outperformance is positive is much more dominant than the cash outperformance. Yes, there are time frames where cash is a good asset to own. Certainly, times like the Great Depression and some other periods of market volatility, especially the one we're going through right now. But these periods, I think, are relatively short-lived. So at some point in the near future, I think we are going to look for opportunities to begin to take that cash and start to distribute it to other areas of those assets. Now, I can already hear some clients screaming, why would we do that when we're getting good yields on cash? And I've had people tell me that they're done with bonds and they've never earned any money on bonds. But I think that opportunity set is changing. And we're really in some rare air here in terms of treasury bond returns. I mean, if you go back to 1928, you can see all of the yearly returns on the 10-year treasury bond. And we've never had a period of 3 negative years in the treasury bond market. And right now we're sitting at that with the largest loss in the 10-year treasury on record, smack dab in the middle of that. So just like you would see some of these extreme return profiles in equities, and you would want to take advantage of that, I think you're starting to see those things pop up in the bond market. Now, what I would say is I wouldn't expect us to take our slug of cash and overnight toss it into the bond market. I still think it's going to be a slow process, but I think we're probably closer to that than we are further away from it. And just to kind of give a risk reward example from what a 10-year, what this might look like, here's the 10-year treasury rate going back to 2019. We've got a high level when we printed this chart at 4.37. The 10-year treasury is actually about 10 basis points higher than that today. So it's closer to 4.47, 4.5. But if we look at that and we have a duration of around 8.1, so you can even look at that in years, percentage, and all that does is it talks about the interest rate sensitivity of the price of the bond based on which rates are moving. So here would be the hypothetical 1-year returns if we were to buy these 10-year treasury bonds today. So let's say rates rise another 1%. They go up to 5.5. Okay. So the yield return that you would receive on that over the course of the year is about 4.4%. And then the price return would be negative 8.1%. Obviously, nobody wants that. But the total return there would be 3.7% loss. Obviously, nobody likes to see losses in the bond market, but this is what I would say is probably the worst case scenario. Then you've got the rates unchanged. Let's say that growth kind of slows down. Inflation starts to tame itself and rates just kind of level off here. Obviously, we have no price return, but you're going to collect your 4.4% yield and your total return is going to be about 4.4%. Now, let's say rates fall 1%. Let's say growth slows down. Maybe the Fed changes their tune a little bit. You've got, your yield return of 4.4, but now you've got a price return of 8.1 for a total return of 12.5. So this is, these are equity-like returns now we're seeing if we get a drop in rates. And I think the important thing to look at here is the risk of the worst case scenario, loss of 3.7% versus the reward of the best case scenario of 12.5. You're starting to see that the reward outweighs the risk here by a factor of about 4 to 1. And when we look at opportunity sets like this, you want to be adding money to ideas like this when those risk reward ratios are skewed like that. So as we see rates continue to move higher, I certainly think that in the near future, we may start to allocate some of the cash that we have into some of these opportunity sets, both on the fixed income side and maybe even perhaps on the equity side. So now that we've gone through fixed income, Dan, I know people are probably wondering, what does this mean for equities? And we've certainly had a volatile 2 days. I think today was the first 1.5% sell-off that we've seen in quite a while. So, what does the equity market tell us right now, and what might it do through the end of the year?
Yeah, absolutely. So throughout this period, September, August, this is the seasonally weakest part of the year. So on average, September is the worst month of the year. And it feels like everything's happened right on schedule so far. You've seen a little bit of volatility with the Fed. You're seeing risk assets dip a little bit. But yeah, it's been a really interesting year. You've had, SVB, you've had the AI boom, you've had a debt ceiling crisis, and now we're heading up on a government shutdown. You'd probably say this is a completely unique stock market year, and there's no real other instances you can compare it off of. Well, in reality, if we look at this chart here, this is the pre-election cycle average return for the S&P 500. So the blue line right there is an average S&P 500 return year in a pre-election year. So this goes back to 1950 to 2019. And you can see in red, this is our year to date. It's not too far off of what we've seen from the average. So you could almost say that this year from a return perspective is pretty normal. So we've expected the market to kind of churn and really kind of work through these next few months, because seasonally it's pretty tough, and it's almost working exactly on schedule. Now that's not going to cause us any concern, because as you can see towards November and December, the right of the chart, the markets tend to rally into year end, and actually the election year is also a pretty strong year. So if we're just going on seasonality alone, we knew this chop was going to come, and there's definitely a lot of opportunity going forward through the year end. So we've had this volatility. We've had the Fed saying higher for longer with some hawkish comments, but it's definitely not a time to worry about equity risk, because we have history on our side telling us that going into an election year, equities usually perform pretty well and they rally into year end. So that's definitely something that we can see going forward. Also, another thing is the US dollar. So the US dollar for the past few years has been greatly inversely correlated with equity prices. So as the US dollar has risen against other currency pairs, US equities have come under pressure. As the US dollar has fallen, it's given equities a nice tailwind to fuel rallies. So this chart here, right here, shows the last 10 months of the US dollar. As you can see in the far right of the screen, we've hit this very strong resistance level that's been really prominent for the entire year. So as you're seeing this dollar hit this resistance level, you're starting to see a lot of the internal trend and momentum indicators telling you that this rally, as it should, is slowing down at a resistance level. The lines on the bottom are actually the MACD. So that is a moving average convergence divergence indicator, and it essentially shows the momentum and strength of a trend. So as you can see, the MACD is also hitting up on that resistance level, and it's starting to roll over. And what that tells us is the US dollar probably doesn't have the momentum to break through this resistance level and continue to head higher. So if we were looking at this from a purely technical perspective, we would think that the dollar would hit this resistance and potentially start falling, which could also follow right on schedule with our year-end rally. Another thing is, so in a year like this, you'd think, hey, we rallied really strongly at the beginning of the year, and now we're hitting this weak period, August, September. Okay, the rally's ending. We're probably going to give back our gains from the beginning of the year. Equities are pretty risky right now. But once again, history tells us there's a little bit of a different story there. So this chart essentially shows us all instances where through July, the S&P 500 is up more than 10%, and the August is either 0 or negative on a return basis. every single one of these periods, as you can see in the very bottom highlighted in yellow, there's a 100% chance, or 100% of all historical instances, the August through the end of the year period has been positive. Okay, great. That could be 1%, 2%. Well, the mean return is actually 9.9%. The median return is 8.7%. So when we run into these instances with pretty strong rallies at the beginning of the year, followed by that sluggish August, September period, history shows us that there was a lot of returns still left on the table towards the end of the year. Another thing that we have to worry about or to think about is the Fed. Casey talked about 11. I'll tell you it's 12. The Fed's going to raise, or set to raise, next month, potentially for the last time. And when we look at the last hike, history also tells us a little bit about how equity markets react to the last cut or the last hike in a Fed cycle. So the black line on this chart is the median S&P at the end of the Fed hiking with no recession within a year. Now, the brown line is the median S&P at the end of a Fed hiking cycle with a recession within a year. So this is telling us two very different stories. So if we are in a normal environment, the Fed nails this soft landing and the economy doesn't run into real issues, from an equity perspective, the Fed pausing is a very, very bullish moment. If the Fed comes in and pauses and the economy starts to really struggle, they can't handle the higher rates for longer, and we head into recession, that's a moment in which we will have to be really worried and all bets are off. But again, as Casey talked about earlier, you have positive corporate earnings growth, you have positive GDP growth. The unemployment picture is very strong. So if you're looking at this chart right now, you have to assume that the outcome is going to be the black line, where equities are going to continue to rally with this pause until proven otherwise. So once we get the proof that there might be a recession on the doorstep, all bets are off. But until we see that proof, we have to assume that equities still have a lot of room to run through year end and into the next year. So we're going to talk a little bit about how we're going to position our equities, or what scenarios would have us change our equity position. So status quo right now, that soft landing scenario, the Fed hikes rates to the highest levels it's been in a very long time, gets inflation under control, corporate earnings shake it off, and they might slow a little bit, but they're continuing to grow. GDP growth is still positive. We'll probably maintain a pretty similar positioning. What we would expect to see from the market, we would expect to see a little bit of a broadening out. So places like small caps, places like value, places lower down in the cap scale should benefit from an environment which the recession fears have started to subside. In that environment, we have a small cap positioning, we have some value positioning. A lot of cyclical value names would perform pretty well in that scenario. If we start seeing signs of late economic cycle, so you're starting to see corporate earnings starting to slow, GDP growth starting to slow, not quite signaling recession, but showing late economic cycle, things would be looking to probably add to the portfolio would be things like energy. They would be things like healthcare, utilities, consumer staples. In these environments, the economy is not ripping and growth isn't anywhere you look. So you're buying things like utilities. You're always going to pay your gas and electric bill. You're always going to buy toilet paper and soap, so consumer staples. So in a late economic cycle, when you start to see things really slow down, which we're not seeing yet, those would be positions that we'd probably be adding into the portfolio. And then the recessionary environment. You're seeing corporate earnings fall. You're seeing GDP growth fall and go negative. you're seeing a very tough time in the economy, we would probably, all bets are off there. We'd probably be looking at outright removing risk from the portfolio. So not only buying the defensive positioning, the utilities and staples, but outright eliminating some equity exposure from portfolios. So again, we're not quite seeing recession yet, or the evidence isn't quite there for the recession. But if it does come, we would definitely be looking to remove risk from the portfolio and probably pretty quickly.
Great. So a few questions that we had come in. One, I guess, we'll touch on kind of the slide that we just had, Dan. We talked about different parts in the economic cycle. What part do we as a firm believe that we're in right now? And do we think anything is kind of changing right in front of us? I guess I can go ahead and start there. I mean, as Dan kind of laid out in that last slide, I think we're probably closer to late cycle than we are to early cycle, but I also don't think that we've seen enough data to indicate that that late cycle has started. I mean, you've seen things like energy perform pretty well, which isn't surprising when you've had kind of a rise in oil prices. But if you look at some of those defensive or more defensive names against just the overall market itself, there hasn't really been that consistent trend of outperformance of those assets. So I think until we see that taking place, we wouldn't necessarily deem it late cycle quite yet. What I can say is I don't think there's anything to say that we're in the recessionary scenario quite yet. So that's a good sign.
And Doug, just to kind of follow up on what you said, there was a specific question related to an individual security. So we won't mention the security specifically, but it was a security that has to do a little bit more, that's tied to maybe a little bit more accelerating economic growth and the recent change that we made. And as Doug and Dan have mentioned, I think with the analysis and thought that we're more likely late cycle, that's some reasoning for that change, that the specific security somebody had asked us a question about tends to be a little bit more in a accelerating economy, and if we run into a little bit more headwinds or things slow a bit, certainly we think it's a little bit more late cycle, at least at this point. So
yeah, I think that specific question, we will reach out to that client individually and provide some more color on.
Yeah.
Another kind of not necessarily security specific question, but thoughts on maybe the NASDAQ or more growth areas of the market as it relates to where we might be going into the end of the year. Obviously the 7 stocks at the top of the index have driven most of the returns this year. What I have found interesting is over the last 2 days, I think you've had some pretty bad relative performance of some of those assets against the market. So, I mean, the big story with those obviously is valuation and how much of an impact that would have if rates stayed higher for longer. I think some of those names at the top do a really good job of producing a lot of cash flow, which is always a good thing. But and the fact that you've got passive money through 401ks and other avenues just constantly flowing into those, they're always going to have a bid. But I think at some point the valuation, I think, is going to catch up with those names, and you're going to have participation from some of the other areas of the market. And I think if you did get into a recessionary environment, I don't know how those names come through unscathed. I mean, similar to what you saw in 2022. But I think it's an area where you still want to have some exposure in your portfolio to, just to make sure that you know you do have some access to some of those names. And I think I would say some of them are better than others in terms of the fundamentals, but you know, they're also getting a lot of flows through passive indexing as well. Sorry, I'm just trying to read through this here quickly. So how does the huge amount of money in M1 and M2 affect the Fed's ability to control inflation? Is stagflation possible with a recession? So, I mean, I would say stagflation by definition would be possible with a recession, because you would have, you know, slow to no growth, but then you'd also need an inflation component to it. So the challenge there is if you do run into recession, usually that brings the inflation rate down. But you know, I think that's probably the worst case scenario, and what people would not want to see. You know, in terms of the money supply, you know, I think we forget too that the Fed is still actively doing quantitative tightening, where they are, you know, reducing their balance sheet and seemingly trying to pull money out of the system. I don't have the chart up in front of me, but I think this is the first year or first time that we've had year-over-year M2 growth that's actually been negative since they've been keeping track of that. So, you know, there is some contraction in terms of money supply, and obviously, you know, inflation 101 is, you know, too much money chasing too few goods. So that has always kind of been a concern. But I think, you know, the Fed does have the ability to try to turn that toggle on and off through quantitative easing or quantitative tightening. I think right now, you know, as long as things are not falling apart on the economic front, I think they're going to continue to try to reduce the amount of money that's in circulation and hopefully avoid any kind of reacceleration of inflation. But, you know, I think it also can be argued that this inflation was spurred on by something that was as much supply side with COVID as it was, you know, with the amount of money that's kind of been tossed into the economy. So, you know, stagflationary environment would definitely be something we don't want to see. And I don't want to rule it out completely, but I would say for now, that's probably one of the less likely scenarios that we would see.
Yeah, I mean, surprisingly, at this point in time, you know, both consumers and business have still been reasonably strong, but something we're certainly keeping an eye on as time goes on. If that picture were to change while still dealing with some inflation risk.
So, Casey, I don't see any more questions on here, so you can go ahead and take us out.
Well, thank you for the trust and confidence that you've placed in HCM. These no doubt are challenging times that we're dealing with. And please don't hesitate to reach out to us if you'd like to discuss your individual plan. We're glad to help. And if there's a family member that we can help, please don't hesitate to reach out to provide an introduction. We would be honored. Thank you and have a wonderful evening.